So today we are doing a Sunday video, and basically this video was the video that I was supposed to do on Friday, but obviously as you guys saw there was a special guest on the channel and I put that on Friday because I thought that was a really good video for the weekend. So I'm going to do this video now that was supposed to be on Friday and covering what's going on with the stock market, because as you've probably seen, it's a little bit weak out there. There's the indexes not doing so well, and a lot of individual stocks as well. A lot of those individual stocks are down 20% at the moment, and we're going to talk about that. So yeah, I'm basically going to fill in the news that I was going to cover on Friday today for you guys, so I hope you enjoy it. Just before we do get started onto the video, I just want to say if you do want to join the Patreon, link's in the description. If you join through there, you get my live buy and sell alerts, and I'll also give you 2 exclusive videos a week as a reward for supporting the channel. One of them was this, which is how to structure a portfolio, which we talked about on the Patreon and the Discord. So if you do want to see that exclusive content, only £5 a month, help support the channel, links in the description. So first of all, I just want to recap the video on S4 Capital and the interview with Sir Martin Sorrell that came on the channel. You guys seem to really enjoy the video, and I actually thought as well he shared some great information with us guys. I think the big takeaway for me was learning about his disappointment with the profitability side of the business, but also his demands to see where he wants to see the company going forward, which I thought was also really good. And I thought it was really honest as well. I thought it was honest, you know, he didn't come in and say, yeah, we're absolutely smashing it at the moment. He was saying, like, you know, there's a few things that we need to work on. He clearly wasn't happy with the profit warning that they gave out, and he feels like that has let the company down a little bit. And I thought it was a really good interview. I was at the point of view where, for me personally, I was a little bit like, do I wait for the business to improve a little bit more before buying some more shares? But it gave me a little bit of confidence as a shareholder to kind of go, maybe it is worth nibbling these shares if they can get to longer term profitability that they are aiming for, and unless they're aiming for, maybe it's actually quite a good opportunity to maybe buy a few shares at the moment. But overall, I'll say, yeah, once again, thank you to Sir Martin Sorrell for coming on the channel. It's something that I've been trying quite hard for. I think we've been working on it for around about 3 months, and eventually, with it being the week of the earnings, it was a very good time with him having a lot of media commitments, I think, to kind of give up 20-30 minutes to kind of come onto the channel. And a few of you guys have asked potentially, can I get any more guests on? I will try. I always am trying in the background. It is really hard to get people that are in management teams to come on the channel because they are so busy, especially on very large market cap companies. But I am trying. There's another 2 CEOs on UK companies that I have asked over the weekend to come on the channel. So if I do get anything, you guys will obviously see. But I appreciate him coming onto the channel, and I thought it was very good, and he was very honest, which was fantastic. I want to shout out Alibaba. Alibaba had a really good day on Friday, where the market didn't have a very good day, up 5%, and we're seeing more signs that the government are being a little bit easier on these Chinese companies. We saw them kind of crack down massively during 2021, 2022. We saw a lot of Chinese stocks basically killed on share price. Alibaba, JD.com, Huya is another one that I own. They cracked down on all these stocks really hard and then got absolutely killed. And now the Chinese government are kind of looking at it going, oh, but now these companies aren't doing that well. It's hurting our economy. We're not making as much money now. The businesses aren't making as much money. And you're starting to see this little bit of easing going on from the Chinese government that should help the companies going forward, and it's good to see that happening more and more. I think that's one of the things that I'm kind of factoring here, is that obviously one of the things you've always got to be cautious of when buying Chinese stocks is the Chinese government, but they went very fast to the one side, and now it looks like they are easing a little bit more, which is obviously really good to see. So good news for the Chinese stocks there. Now getting on to the video, which is obviously talk about the poor performance that's recently going on. Now what I was actually quite surprised about is actually when you look at the S&P 500, it's only really down still 4%, which isn't that much. It's not really a crash, is it really? But what was really strange for me to see was the Russell. When you look at the Russell since September, the Russell is actually down 7.5%. It's nearly double what the S&P is down. And I'm still so surprised to see the Russell, which is obviously made up of small market caps, obviously it is a lot more volatile, but it's still massively, normally the Russell is moves down more than the S&P 500, and it normally moves up more than the S&P 500, but it's not moving up. But every time it goes down, it always moves down in the S&P 500, which is a trend that keeps breaking. And I'm really surprised when I keep looking at the valuations of like the small cap. Obviously this is the S&P 600, which is obviously once again small caps, not the Russell 2000, but they're kind of similar, they move very similar. And I look at the small caps and I still look at the valuations and go, right now there's only 2 points the S&P 600 small caps has been valued this low, which is during the CV times and which is during the Great Recession. They are valued still so low. And I'm not an index buyer, but the amount of times I've thought about buying the S&P 600 is unbelievable. Like, it can't keep staying down here this long. But it does do, and it still gets massively affected. And then you look at the S&P 500, which basically has only been higher 2 points in history, which is the whole kind of CV bubble kind of thing and the tech bubble. Those are the only 2 times the S&P has been valued this high, but yet the small caps still get punished by the S&P 500, which I still think is absolutely bonkers, and a big disconnect that's going on at the moment. Now, obviously, there is a lot of negativity in the market, because when we do look at the individual stocks in a second, you'll see they're actually being pulled down quite a bit. And why is that happening? Well, it seems like I would say 25% of the reason is oil prices. Oil prices continue to go upwards, and we've seen even in September, we've seen a big jump up in oil, and you've seen it gone from around about $78, obviously all the way up to $90. That keeps going up at the moment. And I think people are worried that obviously if that keeps going up, inflation isn't going to come down as rapid. That's going to be one thing that holds up the inflation. And obviously that leads to the Fed. And the Fed obviously came out and said that obviously they see more hikes. They see the higher interest rates being higher for longer and no cuts coming in anytime soon. The market did not like that, obviously, because a higher interest environment means the economy normally slows down. And this is something that I've been on about. Like, I've looked at Jerome Powell and I've said that obviously if he keeps doing what he's doing, he's going to cause the economy to slow down and stocks won't do that well. And that's, the stock market is future thinking, and that's what it's kind of pricing in. And this is why for the last kind of couple of months, when I started seeing the Fed hike up in the last couple of times when they shouldn't have been hiking up, I look at that and go, well, if that's going to happen, then you're going to see the economy do poor. That leads to share prices doing poor. That leads to companies' earnings doing poor. It's not going to be good. So if this keeps happening, for me, I think the stock market, especially when you look at the S&P 500, if the S&P 500 is going down and it still drags the whole market down apparently, then we'll see some weakness in stocks, and I think we've started to see that. And even I look at companies like InMode, for example. InMode since around July time has lost 28%. Like, that is, you talk, what do you define as a crash? 20%. And InMode's down 28%. It's down to 15 times earnings. And this is despite the company has done an EPS beat, it's done a revenue beat, and it's hiked up its outlook. It's growing at 19% year over year, and it's down, we talked about this the other day, 15 times earnings. And I said, I won't buy InMode unless it goes, crazy low. But that's happening. We only talked about it the other day, and once again, it's already falling down like another 5% since that time frame. And I'm like, maybe I'm going to end up buying InMode. And it's one of those that it's, as an individual investor, these are the times that can be frustrating when you own a company like InMode, and yet the company comes out with a triple beat, beats EPS, beats revenue, beat outlook, but yet your stock still gets punished. It is frustrating, but we've seen this. We saw it happen in 2022. How many stocks did you own which went down and down and down, even though the financials were performing absolutely amazing, because the whole market got dragged down? And we're starting to see this again. Hims and Hers. Year to date, Hims and Hers is now down 5%. Since its highs in May time, the stock's down 50%. It's lost half its value. And yet, what was the last thing we saw from Hims and Hers in August time? We saw it beat EPS, beat revenue, grew 83% year over year, hiked up its outlook, triple beat once again, but yet the stock is down 50% since May. It's a little bit frustrating, isn't it? But these are the opportunities that are starting to be created once again. And you look at SoFi. SoFi obviously peaked around July time, $11, down 34%. But what do we see there? Revenue beat, EPS beat, outlook hike, and it is a little bit frustrating. But from all these stocks, when you last saw a crash, what did you get out of buying them crashes? If you were buying InMode back in 2022, you're happy you bought the dip. That stock, apart from the recent dip that it's been on, you were up 93% on those shares. And Hims, if you bought the dip in Hims in 2022 when the whole market decided to sell off, even though these companies were doing really well, you're up 243%. SoFi, if you bought in the 2022 crash back when it was $4, you're up over nearly 100% on that one. So even though it's a little bit frustrating at the time that your stock's getting pulled down, even though they're doing amazing, you've got to learn that these are good buying opportunities normally. You know, these are very good opportunities. So if it can be frustrating to see them going down, even though they're doing well, but what you've learned is that if they do go down, you just look at them as buying opportunities. And if you were buying them in 2022, I'm sure you're thinking, well, I'll take that opportunity again to, you know, buy more shares. So a little bit frustrating, but should be seen as an opportunity. And what it's also doing is it's then creating opportunity in stocks that potentially you don't own. I was looking the other day, I was looking at Enphase. I mean, Enphase was such a popular stock, you know. They obviously helped with the Ukraine situation, oil going crazy, energy prices going crazy. Everyone went, oh, you know, like get solar energy. They saw a boom. Now they're all coming back down again, all them prices. People aren't, and higher interest rates, people aren't, you know, going to solar as much. But realistically, solar in the long term, what's it going to be? It's going to be a major winner, you know, major winner. You know, if you have a solar plate, it's probably going to do really well in the next few years. So then you get in a stock like this that peaked at, you know, $339, and now it's fallen 64%. And this company now is trading at 30 times earnings. I think on a forward basis, it's dropped down to like a 19, and yet it's still going to be, you know, a solar space that's in the solar space that's still going to be growing probably about 15% a year on revenue basis at 19 times forward earnings. You start seeing the opportunity, you know, for a company that's going to be a major player in the next few years. You know, it looks pretty attractive. I mean, I'm looking at Lovesac. You know, I used to own Lovesac, made some good money on it. I sold it out because I was a bit worried that the housing market was going to slow down, interest rates start kicking in, and that's what we've started to see. And you know, you're starting to see this stock go back to $19. And even though I'm still nervous about the industry, you know, if you start giving me Lovesac at like $15, $14, $13, I mean, it might be a bit of a painful 12 months, but this company is a fantastic company. You look at their business model, and as soon as these higher interest rates come out and people start buying houses again, this stock will do absolutely amazing. And I'm looking at that going, is there an opportunity here? You know, it might be a tough time for the next kind of 12 months, but it could be an opportunity. Looking at Tesla, you know, Tesla is, in my opinion, still a bit of a rich valuation, but if these higher interest rates carry on hurting it, if the stock market keeps pulling down, you know, what do we see with Tesla in 2022? We saw Tesla hit $123. I've seen people saying, oh, it won't go to $123 again. It happened in 2022. So if we have the same sort of negative sentiment come around and these higher interest rates kick the financials, you know, you might get another opportunity there. And that's, you know, this is why it's really important as well in this time frame to be creating a watch list. I mean, Celsius. I'm a big fan of Celsius, and then I got a bit worried around the financials, sold it out. Probably shouldn't have sold all the position out, but you know, we made some good money on it. And since then, you know, the stock has gone absolutely ballistic. But you know, you look at this, and even though the company's doing, you know, amazing financially, granted it went to a little bit of a stretched valuation, you only get that little bit of negativity in the market, and look what difference that can make for a stock like this. You know, within 1 week, you're losing 15%. So, you know, if you get a longer stretch of time like this, you know, quite easily you might see Celsius start pushing down to the, you know, $120 range, and all of a sudden you're going, well, could that be an opportunity? So it's one of those at the moment where you can see why the market is having a bit of a tough time. I've got to say, I don't think it should be the small caps that are getting punished as much as they are, considering the valuation, but they are. There's stocks out there that are financially doing amazing and are still getting pushed down, which we exactly saw in 2022. But what did it all create? It all created buying opportunities. And as a long-term investor, it can be, like I said, it can be frustrating to see your gains going down a little bit at this moment in time. But what you've got to remember is you've got to put yourself back in that 2022 situation and think about this negative sentiment. Really, it won't be bad if it does take over, because you do get them stocks at good valuations to make, you know, a lot better money if they go up. So, I mean, this is exactly why I was kind of, you know, wanting to build up cash pile, is in case this happens, and it is creeping in a little bit. I mean, we'll see if it gets a lot worse, but already it's amazing how it can take so long for, you know, the share prices to go up and up and up, and it does amaze you how, you know, you can see, you know, a year it takes for that share price to go up, but within 3-4 months that share price goes down. It's amazing. The old saying is that the bulls take the stairs and the bears take the elevator. You know, steady goes up, and it shows you how quickly negativity and fear. This is what I talk about all the time. Fear being the biggest emotion in the stock market. As soon as that takes over, it's crazy what that can do to the market. And mindset is such a big thing in the stock market, and it shows you when this takes over, how quickly it can take over and send things down. And we are seeing that a little bit here, and we're seeing some opportunities being created. We'll see if it creates even more bigger opportunities, because it can do if it does take over. So we'll see. But the big thing I want to take away from here is, remember what happened last time was when we had a bit of a dip and the opportunities it created, and don't let it affect you in the longer term as a shareholder, for sure. Hope you enjoyed it. Hit the like button if you're not here, subscribe. See you in a bit.